First rates will just start coming up on your screen. We are starting with the green on the screen. 66 points up for the Nifty, flat start for the Bank Nifty, a mild markdown for the small cap index and a mild markdown for the mid cap index. The market breadth I think is looking decent, but the real hero today I think is Tech Mahindra. They've got a new CEO now, and could there be a change of fortunes for Tech Mahindra and the fortunes of Tech Mahindra? Adani Enterprises, Hindalco, JSW Steel, ICICI Bank, Apollo Hospitals, Adani Ports. Some names where news is not that important, but the price action seems to be constructive. Let's now look at banks and especially PSU banks, which really got knocked out. And then Mr. Katpalia has got a 2-year extension, not a 3-year extension. I'm sure it will have an impact on the stock price of IndusInd Bank. Without even guessing, I can tell you. There you go, thought as much. Now markets are saying why 2, why not 3? 3 was better than 2. Is that something we don't know? But these things happen, guys. I mean, Federal Bank and a lot of other bankers have got extensions, which are sometimes 1 year, and then they've got extended. So I don't think you should read too much into it, but markets are markets. Markets knew this extension was coming. It's turning out to be a case of buy the rumor and sell the news for IndusInd Bank.
Yeah. The Adani group of stocks as well, considering they fully prepaid that $2.15 billion share-backed financing ahead of the deadline. You're seeing Adani Enterprises jump up almost about 3%, Ports holding higher, Adani Power is looking up by about 5%. I want to see what Ambuja etc. as well are up to, because it seems that the promoter has repaid $500 million facility taken for company's acquisition financing as well. That's Ambuja Cement that I'm talking about, 2.25% higher for Ambuja as well, currently in trade. Lupin, the US FDA has completed the inspection of the Vizag facility with no observations. So this would definitely be a fair amount of relief. Stock holding up 1% as we speak right now. There's HAL. They've signed a 667 crore rupee contract to supply 6 Dornier 228 aircraft to Indian Air Force. I want to see what Sona BLW is up to. It's a sizable, chunk. Blackstone is looking to sell their entire 20.5% stake in the company via block deal, which is going to happen around the 400 rupees per share mark, as we understand. 410 is where the stock is down sharply, about 6% as we speak right now. What is Infi up to? Tech Mahindra's gain is also Infi's loss. So let's see what Infi is up to currently in trade. Absolutely flat right now. Well, clearly the big star performer today is Tech Mahindra. Nazara Technologies too, wherein the two subsidiaries hold cash balances at SVB or Silicon Valley Bank. That has, gapped down 3.6% lower. And then Mahindra CIE, wherein M&M was looking to sell that 4.6% stake in the company. That I think has happened, 7.5% lower for Mahindra CIE as we speak right now. But that said, it's pretty much in line with what the SGX Nifty, or for that matter, some of the select Asian market recovery has been. To be able to even see green on the screen itself is, I think, remarkable, and we are well above that 17,450 mark, 17,478 on the Nifty spot as we speak right now, and futures are currently skirting around that 17,500 level. Kunal, not bad. Who would have thought when we went home on Friday that we'll see a recovery on Monday?
Well, absolutely. I think Kunal thought. He said that if 17,300 is intact, he'll buy on Monday.
Thank you, Nikit, for that. But
did you buy is important. That's so.
Today I'm buying.
Yeah.
Today I'm buying.
So, today
yeah, on Friday we were very clear that we don't want to take a call just because the risk reward is attractive. You have to wait for that period of bounce. I think after today's move, it indicates that the market should stabilize, and the 17,300 is a good support. So the first stock which I would be looking to trade would be Cipla, more on a contra trade, just around that 880 odd mark. Looks very attractive. Purely from a risk reward, but as I said earlier, that I think it's a good time to now add on to more high beta as well as few large cap names as well.
Naresh, what is your first trade?
So accumulating, starting with a small position on Balrampur Chini again, expecting it to consolidate here before the breakout. So would actually want a little more dip here.
Now to bring on board Nilesh Shah, Managing Director of Kotak AMC, and today we'll not talk about India, we'll talk about his understanding of what is happening in the US market. First, the fall of SVB and now this rescue. Nilesh bhai, good morning. I know it was a late minute request, yet you managed to accommodate it, so really thank you for that. Just break it for our viewers that why this bank has failed, and after the rescue by the Fed for depositors and for existing borrowers, has the storm come and gone?
So Nikunj bhai, SVB was geographically concentrated bank in Silicon Valley, having very high concentration of bulk deposits. About 97.3% of their deposits were above 250,000, which is FDIC insurance limit. So it's geographically concentrated and sector concentrated bank. Their clients were mainly startups. They all got a lot of money when interest rates were low a couple of years back. SVP took deposits at attractive rates, and in order to earn carry of 40 basis points, they went and invested into mortgage-backed securities. This mortgage-backed securities were giving carry in the initial days, but as US interest rates moved up by almost 5%, there was a huge mark-to-market loss. Depositors who were smart recognized that SVB could be in trouble and started withdrawing the money. In order to fund those deposit outflows, SVB had to sell their portfolio and book losses. In order to recapitalize the bank, they announced a large equity offering of $2 billion plus, and that opened the floodgate. Everyone wanted to get out of the room because bulk of the deposits were uninsured. Finally, FDIC, which is equivalent of RDIC-GC, intervened and took the control of the bank. Over the weekend, Fed has come out with the US Treasury, and FDIC has come out with a relief package. They've ensured that all deposit holders will be protected irrespective of whether they have insurance or not. The equity holders and bond holders of SVB will have to take losses. Another bank, Signature, which was also facing similar trouble like SVB, also has been taken care of. Essentially, Fed has ensured that this contagion doesn't spread. There's no flight to safety from lower rated banks, regional banks, to higher capitalized banks. Depositors' interests have been protected, panic has been prevented, and hopefully they'll now learn from SVB crisis and tighten the regulations. For example, stress testing for SVB was fairly low. There was no restriction on how much they could put into HTM like Reserve Bank of India has prescribed for Indian banks. So I'm sure Fed will take corrective action like they did in 2008 and ensure that SVB is not repeated again.
Nilesh, I also want you to use this platform to try and ease all the Indian investors, because over the weekend or on Friday night, when you had other banking names as well in the US fall, I mean, everything from a JP Morgan to a Wells Fargo to PacWest to First Republic, Citigroup, there was so much panic out there as to the contagion impact that SVB could have on even Indian banks, for instance. So just want you to address to the viewers right now as to how that has no correlation at all, and especially, the retail janta out there.
So essentially, our banking system is in a far better position. For example, SVB, out of their $200 billion balance sheet, could put $100 billion into HTM category. That's not permissible in India. Reserve Bank of India caps how much you can put into HTM category. Second thing, in SVB, deposit outflows moved very, very quickly. In India's case, our deposit base is widely distributed geographically as well as across various industries. And hence, this kind of deposit outflow is unlikely to occur. Third, in SVB's case, they were focused on bulk deposits. In our case, it is retail deposits. And more importantly, our regulators are far more proactive compared to SVB. If you remember, way back in 2008, there was a run on one private sector bank because one of the ATM went dry. It was a local event, not even a regional event, but yet RBI intervened to ensure that that bank remained open and kept on sending cash to repay all panicky depositors. People who were driven by panic and rumor mongering withdrew money, and then next day they all came back to deposit thanks to the immediate intervention at the local level. In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India. We do have our SVB equivalents in chit funds and nidhis and collective investment schemes. More than 1.8 crore Indians have lost close to 2 lakh crores over last 20 years in variety of Ponzi schemes, whether it's EMU scheme, Tickwood scheme, plantation scheme. That segment, the unregulated, unsupervised segment of collective investment scheme is SVB of India.
The comparisons which everybody has again been talking about on social media, now social media is social media, but these comparisons have been drawn that this is a 2008 kind of a Lehman moment. Is that all hogwash? Can we just dismiss it with a big no?
So undoubtedly, this is not Lehman Brothers movement because one, post Lehman Brothers movement, Fed came out, the US came out with Dodd-Frank Act, and it took away some of the luxuries which financial sector in US had earlier in terms of leverage. Second, Fed supervision has increased substantially on what is quote unquote systematically important financial institutions. SVB was falling out of it. Lehman or Bear Stearns would have been inside systematically important financial institution. Social media obviously is in overdrive. They will keep on spreading rumors. Like today, I am part of a WhatsApp group where someone mentioned that in India, bank run is not possible because, when you want to close your bank account, they'll ask you for KYC, they'll ask you so many questions that you will decide not to close the bank account. Now, this kind of comments are completely uncalled for. They are in lighter vein and people should not take it seriously.
Nilesh, you've always mentioned that it's not really any other binary event, nor even SVB. It's the Fed's interest rate trajectory, which is the real big worry and concern and trigger for the market. Going by Jerome Powell's latest commentary, it doesn't seem like the Fed is quite done yet. What happens then in that case if the Fed were to get even more aggressive from here?
So it's $1 million question. If you want living example of between devil and deep sea, there's no better person than Jeremy Powell. He's doing tremendous balancing. If he raises interest rates, over leverage US government, households will have to carry the burden. If he doesn't raise interest rates, inflation does not come under control. Unlike Mr. Paul Walker in the 80s, who had the luxury of raising real interest rates to 10% and nominal US interest rates to double digit, because debt to GDP ratio of US was far lower. Mr. Powell does not have that luxury. And he's kind of playing a game which is, very, very delicate balancing. On one side, he has raised interest rates at the fastest pace in the US history. On the other hand, he has been relatively slow in taking away excess liquidity from the banking system. Fed expanded balance sheet by $4.8 trillion rounded off between 2008 and 22. And now they have taken out about $600 billion. So over 2008, there is still $4 trillion plus liquidity in banking system. So Fed was hoping that by raising interest rates, inflation will come under control. But by not taking away liquidity as quickly as possible, hopefully growth will not go into severe recession or depression, and it might just be a mild recession. For this strategy to succeed, Fed had to ensure that there was no accident. Unfortunately, SVB created a jolt for Fed. Now with Fed, US Treasury and FDIC, they have tried to tackle SVB and signature crisis. Hopefully, Fed will be driven by data dependency. They will carefully evaluate all the incoming data to take a call whether they should keep rates higher and for longer.
The reverse side, that could Fed get more aggressive. But what are the chances that Fed could think that, okay, interest rate hike has started backfiring. whether it is the economy, whether it is the US tech sector or the financial sector per se. So don't increase interest rates. Let's hit a pause. So what happens then?
So Fed will have to be very, very careful because yes, there are segments like housing, technology, startups, where Fed's impact of raising interest rates is visible. But there are sectors like labor market where Fed's impact of raising interest rates is not visible. Inflation has not yet slowed down. US real interest rates are still negative, and hence Fed will take a very, very balanced, nuanced steps in this open minefield. My feeling is that Fed will be kind of, showing the stick of raising interest rates and tightening liquidity, hoping that this will curb the demand. But at the same time, they'll continue to provide liquidity, hoping that SVB kind of accidents don't occur. And we probably come out of this situation with inflation just little above Fed's target range of 2% and a recession which is very, very mild and probably for 1 or 2 quarters rather than which is very, very deep. But Fed will be taking steps based on the incoming data. They'll probably use forecasting models to figure out how their steps taken by them is impacting US economy. It's a very, very tough job. And all my sympathies are with Jeremy Powell. He's doing a fantastic balancing.
That's a good one. Nilesh, great to have you on the show as always, and thank you for, giving us your sound bit of advice and, really explaining what really is going on behind this entire SVB saga. No reason to panic. That clearly is the messaging. By the way, the markets are now up 100 points on the index, that is. We are 0.5% higher, well above the 17,500 print for the Nifty futures. And the spot as well has scaled up quite nicely, so well in the green as we speak right now. Tech Mahindra is now up 8.5%. Adani group of names as well are bouncing up quite smartly, and banks are the ones which are also holding up quite smartly. So Kotak Bank, ICICI Bank, they've all jumped up about 1%, and metals as well are rebounding. So that's also contributing to today's move. Both Hindalco, JSW Steel are holding up as we speak right now. But let's shift focus and let's really talk about resources of the future. Thermax has now entered the green hydrogen market. So let's try and understand what exactly does this imply and what would it really mean for Thermax. We have with us Ashish Bhandari, the MD and CEO at the Thermax Group, joining in the show right now. Ashish, great to have you on the show today. Thank you so much for taking the time out. Ashish, just wanted to understand this latest MOU of yours with Frotesc Future Industries. What is the role and scope for Thermax into green energy, and what possibly could be the level of investment for the purpose that you're willing to make at this juncture?
Good morning, and good morning to all your viewers. Certainly a very interesting previous discussion that was going on as well on what's happening in the larger banking sector, particularly in the US. Similar set of, but very, very big moves also happening, as we've been talking about, in the new energy space, where the entire mix of energy that the world is looking at, as we have said previously as well, is going to go through a transition over the next 5 to 10 years. And Thermax too is working to get itself prepared, and more importantly, work to get the larger industry ready for this transition. One of those moves in those set of things that Thermax wants to get done is the move towards green hydrogen. And this particular move for green hydrogen will involve a lot of different individual but connected steps. The biggest step of which is figuring out what is it that we want to do in the electrolyzer space, and a couple of the connected capabilities in that particular space for green hydrogen. So the partnership with Fortescue Future Industries is towards getting Thermax moving on 3 different aspects of green hydrogen. First is the ability to do EPC of green hydrogen projects, which is helping our customers set up these large projects. And you can see even in the at some of the other announcements that were happening, there are a lot of companies in India looking to set up green hydrogen projects. Thermax can come in and provide an EPC for these customers. Second, we want to very actively explore manufacturing of electrolyzers in India, and looking at FFI, which is Fortescue, as a partner for setting up this manufacturing. Here we are waiting for some of the PLI schemes and some of the other sectoral moves that are anticipated. We are just getting ready in advance of some of these other moves that will happen. And third is the ability to offer green hydrogen as a service, as a product, on a build, own, operate basis to industrial customers. So industrial customers in steel, fertilizers, even refining, many of them that look to move from gray hydrogen to green hydrogen, providing green hydrogen as a service to those customers. So the EPC, electrolyzer manufacturing, and build, own, operate, those are the three elements that are part of the MOU that we have done with Fortescue.
What will be a total initial outgo? And are these long gestation projects where you'll have to invest a lot and the returns will only come after 3 years?
So first, in terms of how much investment, we have some order of investment that we have done internally. Too early to talk about, because a lot of it will depend on how the sector overall takes off and what is the what are some of the government policies that are anticipated as well. So I'll hold off in terms of investment value. Of the three elements that we talked about, EPC clearly is a relatively lower cost, more a people investment in putting a whole team together to be able to do all of this, that we are committed to. Second is electrolyzer manufacturing. That is, while it is a slightly variable area, it is something that we have a range of numbers based on whether we want to set up at the higher end a 1 gigawatt facility, or at the lower end a 250 kilowatt facility, depending on the range that we want to go for. We have a range of what the capex that will be involved. The third part, which is more longer gestation and perhaps longer contracts, is the build, own, operate version, which, as I said, we will limit ourselves primarily to industrial customers and to smaller projects, which is not Thermax's intent to go for large utility scale projects. For the large utility scale projects, our aim is to more provide the EPC and the electrolyzer capability.
Sure. Also wanted to understand whether you're going to be exploring these green hydrogen projects outside the country as well.
So on the outside the country, the first and the second elements, which is the EPC and the electrolyzer manufacturing capability that we look to put in place, will both be for India as well as for global markets. And we do think this is competency where India as a country provides strong engineering basis, and with some of the benefits that are expected from the government, potentially a strong made in India and a manufacturing basis as well. So for the first two buckets that I spoke about, yes, we will explore global opportunities as well.
Could you give me some, visibility on what the order book could look like, both as, exports as well as domestic?
I think too early to say, and we may have to wait as much as a year to get any visibility into these things. Yeah, even on the Indian front, I would say the last few months, things have been slightly slower than what I would have expected. The PLI for electrolyzers, it's not imminent when they will come out. Also, there was expectation that certain industries will mandatorily have to use some amount of hydrogen as green hydrogen. That policy is also now being passed on to an empowered group, which is the news that came out last week, as opposed to the MNRE deciding on some of these requirements for the industries. So I think that decision and that discussion will also prolong for a little bit. We come in with the confidence that both of these things, it's not a matter of whether it will happen or not. They're more a matter of when it will happen. And we are looking at the sector more for the next 10, 20 years and not in the immediate next 12 months, I would say.
Fair point. But tell me, green hydrogen, I'm guessing, requires a lot of R&D and economies of scale as well, right? What are the roadblocks that you see in the implementation of green hydrogen technology?
I think you hit the nail on the hammer on the head of the nail. The two biggest things are, one, technology and R&D. Here, there's some parts of technology, especially the ones around how the electrolyzer cost and the efficiency of the electrolyzer improves, is a area where globally there is a lot of work that is going on. And even today, you can think of maybe there are 50 plus startups that are working on some aspect of electrolyzer portion globally. And the partnership that we have done is also done with that in mind, that you want to have a partner which is working at the cutting edge of this technology and is working not just for where the technology is today and tomorrow, but for where the technology may be 5 years from now. And that was the toughest part of the work that went into choosing who the right partner would be. And in FFI, we think we have the right partner. For FFI also, the question then is, where do they want to expand? Because there are a lot of opportunities globally for them to expand. And if they are choosing India as a market, India should have the necessary basis on why this is a place where they would like to expand, which in their opinion it does. And then second is, why would they want to choose Thermax as a partner? And that is basis of our engineering capabilities, our ability to localize, our ability to understand all the various elements. So the idea on R&D is to partner with best of what the research can bring about, and then how do you localize something? And if you can marry the two elements out, then you have a good partnership, which is what we think.
Seem to have snapped the audio right there. But Ashish, great to have you on the show. Thank you so much for taking the time out and helping us understand what green hydrogen really is all about and what it means for your business after the MOU with Fortescue Future Industries as well. On that note, we're going to take a very quick break, but come right back. Markets in recovery mode. We've got lots to discuss on the other side.
Okay, now markets, meanwhile, there is a bit of stability which is definitely evident. Adani group of stocks are looking up, banks are bouncing back, auto stocks are looking decent today. Fintech and consumer tech stocks which sold off, they are also stable. The top draw is, of course, Tech Mahindra, change of guard there, new CEO, star manager of Infosys comes to Tech Mahindra. Tech Mahindra is a Mahindra group company, but they don't have the best ratios in terms of margins, growth, or even the profile of customers. So can this change of guard incrementally change things for Tech Mahindra in a meaningful manner? That's Mahindra CIE for you also, where a block deals have been done. Tech Mahindra on the screen up about 9%. We'll talk autos, and Jignesh Gandhi, Deputy Head of Research and Auto Analyst with the institutional business of Motilal Oswal Security, joins us now. Jignesh, good morning. Thank you for joining us. It's turning out to be one of those years where the auto trends are slightly mixed. The two-wheeler sales are recovering in bits and pieces, but within the auto space, SUVs are the clear winner.
Right, Nikunj. Good morning. So clearly, the growth recovery post-COVID has been mixed bag across auto OEM segments. As you rightly pointed out, SUVs and passenger vehicle in general have seen a good recovery. Commercial vehicles have seen a good recovery, whereas two-wheelers had been late to the party with respect to recovery is concerned. But clearly, post FY22 and FY23, we have already seen recovery from the low base. Obviously, the base has been so low. I mean, we have more than decade low in terms of the base for two-wheelers is concerned. But on that low base, we are now seeing a reasonable recovery playing out in the last 9 months. So broadly speaking, all the segments are back on recovery path. Even tractors have been doing very well. FY23 is a new high for the industry. CVs, we will be crossing new peak in FY24. PVs, we are already at new peak, and two-wheelers are just starting off with the recovery process.
What amazes me is that if I look at tractors, like you said, they are at a multi-month high. Again, in representation of the rural income and rural economy. But if I look at two-wheelers, and especially numbers from a company like Hero MotoCorp, they are showing me signs of rural distress. So tractors बिक रहा है और scooter नहीं बिक रहा है. How amazing is that?
So clearly, that dichotomy is reflection of nothing but the end application. Tractor is a commercial use for commercial activity, whereas two-wheeler is more for personal use. So keeping good monsoons in mind, good agri economics in mind, tractors have been doing well. Whereas on the other side, the two-wheeler has much wider audience, not just the farmers as such. And given the impact of COVID, given the substantial increase in two-wheeler prices since in last 5 years by almost 40%, that customer is just emerging out of the sticker shock which two-wheelers had seen in last 5 years, along with the impact of COVID on income and at a personal level. So I think that is where the difference has been between tractors and two-wheelers so far. Hopefully, the recovery which we are seeing in two-wheelers, and if prices of two-wheelers remain stable after last 5 years of hyperinflation, we should see a sustained recovery on a low base. We still believe the penetration is quite low for two-wheelers, and that leaves enough headroom for two-wheelers to grow at a consistent pace over a longer period of time.
Dinesh, but what happens to auto margins across the board? Because commodity prices from their, Q3 lows are once again inching up higher. So does that dent margins across the board, you think?
So clearly, the tailwind which we had of commodity prices over last 2 quarters is now slowly stabilizing, and there are initial signs of commodity prices going up, partly in reflection of China opening up. From the lows of 3Q, commodity prices, which matters for autos, is up between 5 to 10%. Almost all commodities are up except aluminium. The increase so far has been quite manageable. Unlike last 2 years where we had seen a substantial hyperinflation in a very short span of time, which made it difficult for the auto OEMs to pass on those cost inflation to customers, the current increase has been fairly manageable. If it sees similar inflation like we saw in last 2 years, clearly that will turn into a material headwind for the sector, particularly from the margins, which are still well below the historical averages, which we have seen over last 10 years, over last 5 years, margins are still well below that. So if commodity prices remain where they are today on the spot basis, driven by operating leverage mix and favorable currency, and particularly for exporters, we should see margins improving in FY24 and 25. Mind you, we are still not expecting margins to go back to the normal level even in FY25. So any amount of hyperinflation in commodities will be clearly a negative for the sector.
Jinesh, tell me, in your last note, you made a very interesting point where while highlighting how the weight of the auto sector has declined over the recent years, going forward, you expect that to rise. Tell me, which stocks do you think are going to lead this recovery?
So clearly, if you see the stocks which have been impacted because of these cyclical issues, primarily on the large cap side, we have seen M&M, which initially got impacted and seen a spectacular run over last 2 years or so. We do believe that will continue to do well, particularly given their strong SUV order book. But more importantly, stocks like Tata Motors, Ashok Leyland, where we are seeing a good cyclical recovery in India, particularly for on the commercial vehicle side and passenger vehicle side for Tata Motors. And JLR is at right at the bottom, and as supply side improves, Tata Motors should also see a good recovery driven by JLR. Not to mention the recent announcement for IPO of Tata Technologies that will add to the SOTP value between 25 to 45 rupees a share. That could be near-term trigger for Tata Motors as a stock. Similarly, Ashok Leyland, as I said, the stock has been consolidating for last few months at current level. Business has been improving at a very fast pace. Market share recovery has been strong. Margins are just recovering. So that's another stock which we like on the OEM side.
But tell me, when you talk about Tata Motors, you think it's JLR or the domestic business which is going to aid the recovery?
So the large part of delta from here will be by JLR. The India business has been doing well. We expect that to continue to improve, but the key driver will be JLR.
JLR will improve. I mean, they're still struggling with chip shortages. What I also understand is that there is no large product pipeline, at least for JLR portfolio per se. And every time when there's a new product pipeline, the customer migrates from old to new. So why should JLR turn around when world is in a mess?
So clearly, the macro headwinds which you're referring to are is clearly area to be monitored. But as things stand, JLR has three major products, primarily Range Rover Sport and Defender, which have been recently fully upgraded. That in turn is resulting in very strong order book in just three markets, which represent 60% of the volumes. They have order book of 215,000 units, just of which 75% comes from these three recently upgraded models. Demand continues to remain strong. They've been accreting to their order book on quarter basis. And the chip supply, which has been the big drag on performance, is slowly improving. 3Q FY23 was a quarter of new high in terms of production. Post chip shortages were there. Fourth quarter should do better on 3Q, and gradually things are improving on the chip supply side as well. While we are nowhere near to normalcy, from the weak period of last 12 months, things are slowly falling back in place. That supported with a very strong mix, along with the operating leverage benefit, we will see substantial improvement in JLR's P&L as well as balance sheet. In fact, we expect JLR's net debt to reduce from close to 4 billion pounds as of December 22 to little over 1 billion pound by March 25, led by improving supplies, better mix, and in turn improving margins.
If the subsidiary of Tata Motors, which is Tata Tech, if it goes public later this year, what could be the impact of that?
So currently, we are not giving any value to Tata Technologies as a part of our SOTP. That business is a strong business focused on ER&D space. Based on the valuations at which that subsidiaries expected to come up with IPO, along with the valuations which are traded in the unlisted market, we estimate per share value of about 25 to 45 rupees a share for Tata Motors after 20% holdco discount. So that could be a good near-term re-rating catalyst for Tata Motors as a stock.
Right. Okay. Jinesh, great to have you on the show today. Thank you so much for taking the time out.
Pleasure.
Okay, let's move on and let's talk about what else is happening in the market right now. We're holding up in the green, 70,500, edged off just a tad bit actually from the high point of the day, but that's okay. We've seen a marked recovery from where we left it off on Friday and all that transpired over the weekend. US futures continue to scale higher as well. And select Asian markets like HK and China as well are holding up quite well. But keeping our focus centered on the crypto space, despite the industry consistently buffeted by the market volatility, Bitcoin has actually logged some very decent recovery. And it's currently above the $22 mark. Let me take it across to Sharad and find out what exactly is happening here. Sharad?
Well, yes, the crypto market is in focus. For the global crypto market itself is up 7% over the last 24 hours and has also crossed and actually reclaimed the $1 trillion mark in terms of market capitalization. Apart from this, the biggest intraday recovery was seen in almost a month, and if you see from the November lows itself, it's up more than 40%. Now, the important thing is why the jump is coming in the crypto. Of course, the risk-on sentiment is actually kind of wearing off, and this is coming in as the US agencies have pledged that they will fully support the depositors, especially after what happened in the Silicon Valley Bank's crisis. Now, this will be actually protecting the entire deposits money going ahead, and any kind of bank squeeze is there. So that is where Fed will be helping out other banks to actually give out loans on a smaller terms as well as the easier short-term loans going ahead. Apart from this, also the depositors will have exposure to their money in the signature bank as well. Now, a couple of entities are actually been impacted because of the crypto carnage as well as the banking failure which has happened. And of course, we are having Silvergate, which is a crypto exchange, while for the banks, if we talk about it, we have Signature and Silicon Valley Bank, where they have exposure in the crypto space, startup space, as well as the VC space. Apart from this, what lies ahead going ahead, and that is also an important trigger for the crypto industries, as the US senators are presenting a new crypto bill which will come in the month of April itself. Globally, the countries are actually trying out their central digital currencies as well, and way back home in India also the cryptocurrencies are under the Prevention of Money Laundering Act.
Samit, the stock of Tech Mahindra today is actually doing cartwheels. You remember the cartwheels game? Have you played it before?
Actually not.
Okay, cartwheels is that when you go on your hands, Samit, and you start taking runs. So that is what the stock is doing. The stock is doing cartwheel today. Shareholders are extremely excited that a star manager of Infosys has joined Tech Mahindra.
Well, yes, definitely. If you see, he spent his entire career was around 26 years, of which 22 years he was in Infosys, and his last role was as the president of the BFSI and the healthcare segment, which is nearly 1/3 of Infosys' revenue. And he has also led various sales operations and transformation in Infosys, and has led an executive responsibility for large deals across the company. Now, despite this, if you see, there would be some challenges for the new CEO of Tech Mahindra in the company. And firstly is that the fact that Tech Mahindra is culturally different from Infosys. In addition, Infosys possibly has much more mature delivery organizations and internal processes, which is something not present in Tech Mahindra. Moreover, Infosys has only 36 subsidiaries, while Tech Mahindra has nearly 177 subsidiaries. And if you see, 55% of Tech Mahindra's business is largely built on acquisitions, while in case of Infosys, it is all organic growth that the company has done. So if you see structurally, the DNA and of both Tech Mahindra and Infosys is different. So that is one challenge for this new CEO. However, the key task for the new CEO would be, and what Street is expecting him to deliver going ahead, and that's the reason why we are seeing such kind of an up move in the share prices, is firstly is getting Tech Mahindra back to delivering industry average growth rate on a consistent basis. The second is to diversify its revenue stream and focusing more on growing the enterprise business of the company. And thirdly, it is to improve the operations of the company and lift the margins in line with the large cap peers. However, analysts are still saying that these tasks would still take time for the new CEO to implement, and they're expecting these changes to come in effect from FY25. So keep an eye out for the stock. The changes would not happen in the near term, but from long term perspective, the analyst community is very bullish on this new appointment that has come in Tech Mahindra.
Right. Okay. We leave it at that. Clearly, there's only one star performer all the way today, and that's Tech Mahindra. But let's get in some chart busters as well. What is it that Kunal and Naresh are spotting? Kunal, on your radar?
So it's the charts for Power Grid. Aisha, have very interesting charts because very rarely do we see a PSU stock getting into such kind of a strong triangular pattern breakout. And this is a breakout which could probably take the stock much higher to its 52-week highs and even beyond that as well. So this is the charts for Power Grid over the last 1.5 odd years, specifically at a time when the stock was sub 200 levels, 160-70 mark in 2021. How steadily the stock went into a rally, very slow, steady, labored move for a stock like Power Grid. And then comes 2022 second half, where the stock went into a narrow consolidation. So as you can see that the resistance earlier was closer to 250 on the upside, and then starting off to closer to 190 on the downside. That resistance has gotten narrowed with every passing time for the stock. The recent resistance, the mid 2022 resistance was around 240. The range shifted higher to almost 205 as the base. And the very recent one was closer to 230 as a resistance, and the recent base was around 210. So from a 60 rupees zone, the zone has now contracted towards almost 30 rupees for Power Grid, and the stock is now nearing a breakout of this zone of 230 mark. So I believe potentially this breakout could lead to a 50-point rally for Power Grid, which should take the stock higher to 280 levels.
Right. Okay. Kunal, or rather Naresh, Balrampur Chini again?
So looking at Balrampur Chini from a technical perspective, so if you look at the overall history of the way sugar stocks have performed over the last 15 years, is every time there is a cyclical play, they go up 5 to 10x and then fall 50% or more, even 60-70% for a lot of names. And a couple of companies actually go down into total debts. Now, what has changed in the current cycle is after this move in 2020-22, the stocks did not correct 50% as such. They corrected 30% and then started making a base. So that's a very strong indication. Balrampur Chini has now made a base around 310 levels. Now, it was where it started off a rally in end of 2021. Then the base has started shifting higher. The current bottom is around 360 over the last 3 months. And now the stock, after a big volume breakout, is consolidating around 400, 410 levels. So eventually I would expect it to break above the 410, 420 levels and go towards 450 to 520. So at current levels as well as on dips, it's an accumulate with a stop loss at 375 and expecting a new trend to start here with a minimum target of 450 to 520.
Right, okay, let's get in some stock specific ideas as well. Kunal, on your list?
So the first one is a buy on Cipla. That stock remains to be a contra buy, targets of 940, stop loss 860. So the risk reward is almost 1:5, 1:4 for Cipla. And the second would be a buy on Kotak Bank. Even this stock is now heading towards a bottom formation over here, just around the 1700 odd mark. So would suggest a buy with 1680 as a stop loss, targets at 1760.
Right, Naresh, what about your stock specific ideas?
So first is the buy on Power Grid, which continues to remain a favorite, the defensive stock which is making aggressive moves. The stock on a dividend adjusted basis just a couple of percentage points away from an all-time high. Expecting this momentum to continue, a stop loss at 224 and a target price of 250. Second is a risk reward trade on Jindal Steel, which has shown relative strength, keeping a strict stop loss at 579 and expecting a bounce towards 610 in the extreme short term.
On that note, we're going to take a very quick break. Market still holding up, ebbing off a little bit though from the high point of the day. But here's Ramdeo Agarwal telling us why IT is a much bigger story than we think.
IT has had the most dramatic profit pool expansion from 2000. In 2000, it was not even a percentage of the total profit pool. Today, it is more like 15-17% and growing. And there is no year when it has not gained little share. So, my sense is IT story is much bigger. You don't have to stick to the current set of those top big companies. They might give you 10-15% index return or something like that. But below that, there will be a lot of companies which will try to come into the big league. So there will be mid-sized companies which will, because the economics still remain great. And then you have the new set of kind of small companies which are coming up, product companies, AI companies. And so there will be specialized services companies which will be coming up, where the cost structure is in India and the clients are all in US and Europe. So I think that business model has huge potential. We have done in last 20 this is a 23, 24 year story of Indian IT. First $100 billion took about 20 years to get it. And next $100 billion came in just about 8-10 years. The third $100 billion, I'm not talking a small number. Third $100 billion, I believe, is going to come in 4 to 5 years. So that's the nature of expansion. And there, the players who are going to be disproportionately large, I think they'll make it. The stocks cannot fly. You are already trading at almost, you're the most expensive emerging market. You are trading at upper end of your own valuation at about 20-21 PE. So once the earnings growth pick up, nothing is going to stop, I'm telling you. Right now, as we look at things, I think Q4 results are also not going to be very different than Q3. So margin, once the earnings explosion come, see we have about 825, 830 rupees EPS for Nifty, TTL. And that valuation is about 17,000, so about 20 times. So as the market gets confidence on next year's earnings growth, I think market will, I don't think it is going to wait whether if I sell, they buy, market will just blast. Now my sense is we are going to have next 25 years of compounded future. Now what does that mean? India, as we stand today, we are talking about 10 to 11% kind of a nominal GDP growth rate. Because ultimately on a 270, 280 lakh crores GDP, we are talking about almost 30 lakh crores, 28, 29 lakh crores of additional GDP this year. On that you have a 10% compounding every year. So we got 30, 33, 36, 40, those kind of a number, lakh crores of GDP we are going to add up. So the discretionary build up is going to be massive. And the force of, right now the force looks to be more towards the government expenditure on the capex and all. But I think somewhere the trickle down will come and demand will build up. Right now there is a demand, particularly in the rural and all, are not great. But when you, these are all short-term challenges. But when you go into long-term, I think everything will be taken care of. Policy changes will come, which will be, which will help these things taken care of. We are going to have the same, more of the same, I would say. If you go forward, more of the same. We have done 12% compounded at the index level, plus dividend of about 1% or so. So 13% kind of thing we have done, which is, your fixed income is 6-7%. So you are doing 2x of the fixed income. So you can't ask for more. It's a wonderful way. And then if you can get 1 or 2 lucky strikes in your portfolio, it can be whatever, you know.
Do you think there is a strong, not probability, but a possibility that 3 to 5 years, 5 to 7 years, Indian equities can give middle double-digit returns, CAGR?
Because I'm saying nobody on this earth, nobody can tell you the timeline, you know. But if you open
Not
your
point
eyes,
to point, just as a
then I'm
trend.
saying, I mean, in 10 years, if it doesn't go, say, 3x, the index, which will give about 11-12%, I think we'll be disappointed.
You see that kind of invisibility.
Clearly, it will happen. It is bound to happen.
And there's one more thing which I always love to understand from you, from your wealth creation study, value migration.
Yeah.
It's such a wonderful read every time I read through it. Examples of PSU banks losing market share to private banks, telecom companies, Sarkari telecom companies losing to private companies, pharma. For this decade, to your mind, what is the biggest value migration trend?
See, I think the migration which started from 2000, that is IT. I think it is now going to gather pace. You took 20 years to do 100 billion, another 6-7 years to do 100 to 200 billion. Now the third 100 billion will come in 3 to 4 years. So the size of value migration, and that is not only about the building companies and businesses, it is changing the color of the country. So the first tailwind was this thing, India tailwind, that is 10-11% nominal GDP growth rate and 6 to 7% real GDP growth rate. But the real one will be currency gain. So I think India is a terrific story. Nothing is 100%, but I can say 95-97% this is bound to happen.